Buying bonds in a taxable brokerage account versus a tax-advantaged retirement account. Should treasuries go into an IRA or not? Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to our weekly bond update. Markets have come back a bit this week on the hopes of a trade war de-escalation, as the Trump administration sent first signals about a potential reduction in tariffs. Comments about President Trump's commitment to keeping Fed Governor Powell in his current position also gave markets a boost. So, with that in mind, here are the three topics that we'll be covering in today's video. 1. Should bonds, and specifically treasuries, be held in a taxable brokerage account or tax-advantaged retirement account, such as an IRA? 2. Which treasuries rose the most and which ones fell this past week? And 3. What's on the upcoming Treasury auction schedule? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Should bonds, and specifically treasuries, be held in a taxable brokerage account or tax-advantaged retirement account, such as an IRA? Let's start with a bit of background first and begin with tax-advantaged retirement accounts, such as traditional IRAs and Roth IRAs, because the answer is less complicated. We'll be focusing primarily on IRAs rather than 401ks, as most employer-sponsored 401k plans don't generally allow the purchase of individual bonds anyway. So all else being equal, meaning that if we set aside factors such as risk-return profile, liquidity, callability, and so on, in a traditional or Roth IRA, an investor would generally choose the bond with the highest yield. The reason for this is that in a tax-advantaged account, interest earned on a bond is not taxed until it's withdrawn, and upon withdrawal, the interest earned is taxed in the same manner, regardless of whether it's a treasury, agency, municipal, or corporate bond. For traditional IRA, all bond interest earned is taxed as ordinary income upon withdrawal, regardless of bond type, assuming you meet all the traditional IRA requirements. For example, you're not withdrawing early. And for a Roth IRA, all bond interest earned is not taxed at all upon withdrawal, regardless of bond type, assuming you meet all the Roth IRA requirements. For example, the Roth IRA 5-year rule. That's why, all else being equal, an investor would generally choose the bond with the highest yield if purchasing within a tax-advantaged retirement account. As a side note, because I know that there are quite a number of savers in our Diamond NestEgg community who sometimes find themselves having to decide between brokered CDs and treasuries, yes, this does also mean that if you're planning on making your purchase within a traditional IRA or Roth IRA, again, all else being equal, it would make sense to just choose the investment that pays the highest yield, because interest earned on CDs and treasuries are taxed in the same manner when held within a tax-advantaged retirement account. Either taxed as ordinary income here or not taxed at all here. So treasuries, which would otherwise be exempt from state and local taxation, treasuries do not get any special tax treatment when held in a traditional or Roth IRA, like they would in a taxable brokerage account. And it's precisely because of this reason that we often get asked whether treasuries should go into an IRA or not. And my general comment here is this: hold your treasuries in the account that best fits the purpose and or timeline of how you are planning to use that money. For example, before retirement or in retirement. While tax considerations are important, in my mind, it's even more important for you to make sure you have the bonds where you want to have them. For example, to make sure you have access to the bonds if you need them. In our case, we hold treasuries in both our taxable brokerage accounts and our tax-advantaged retirement accounts. The treasuries we hold in our taxable brokerage account are funds that we may need in the short to intermediate term, say for an emergency, property taxes, or other big bills that may come due. And the treasuries we hold in our retirement account are for, well, retirement. So we don't really care if we can't access them before we retire. Now, for those of you interested in tips and Treasury zeros specifically, Consider holding tips and Treasury zeros in a tax-advantaged retirement account if you do not want to deal with the annual taxes due on phantom income for tips and imputed interest on Treasury zeros. Bond Beginners course folks, please refer back to this video in the course here for a refresher on tips phantom income, and this video here in the course on Treasury zero imputed interest. If you're not in our Bond Beginners course, these two tips and Treasury zero videos that I've linked below in the first pinned comment may also be helpful. So, to recap, in a traditional IRA or Roth IRA, an investor would generally choose the bond with the highest yield and ignore basically, the tax privileges that some types of bonds would benefit from in a taxable environment. When purchasing bonds in a taxable brokerage account, the decision process gets a bit more complicated because in a taxable brokerage account, tax treatment on interest earned does vary by bond type. For Treasuries, our general rule of thumb for our personal portfolio is to hold them in the account that best fits the purpose and or timeline of how we're planning to use that money, even if that means that the interest on those Treasuries may lose their state and local tax exemption. If you're trying to compare Treasury yields held in a taxable brokerage account with yields on other types of bonds, such as agencies, corporates, and munis, this video here, also linked below in the first pinned comment, walks you through how to do this using Fidelity's tax equivalent yield calculator. Right, now that we've covered our top bond question of the week on which type of account to hold our bonds, and specifically Treasuries in, let's move on to the next section of today's video. Which Treasuries rose the most and which ones fell this past week? As we so often do at the end of the week, let's grab our rates from the Treasury's Daily Treasury Par Yield Curve Rates page and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. So last week was a bit of a roller coaster for Treasuries again, as some of you may remember. Yields first went up quite steeply on Monday, but then peaked and started coming back down to even a little bit below from where they had been a week earlier. The only exceptions were the 1.5 month, which was up, but only by 2 basis points, and the 6 month, which was unchanged. Treasury yields across all other maturities were down, though, at the end of the week, with the 2-year through the 30-year down the most, between 5 and 7 basis points, which is to be somewhat expected given the run-up in yields earlier this month. Yields on the 1-year through the 5-year remain below 4%. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black and decreases in rates are shown in red. The 4-month is the only maturity that is still slightly higher than where it started the year, as it clings to its tiny 1 basis point increase, down from 4 basis points the previous week. The 2-month is unchanged. All the other maturities are down since the beginning of 2025, with the most significant downward moves to be seen on the 2 through 7-year maturities. The yield curve has gotten a little bit steeper again, with the 1-month and 30-year showing a positive difference of 40 basis points. And the more widely used comparison of the 2-year and the 10-year is showing a positive difference of 55 basis points, meaning that bond investors continue to be more optimistic than they were earlier this month about the direction the economy is headed and the possibility of a recession. Things can change pretty rapidly from week to week and even from day to day in the current environment. So as always, stay tuned. We'll keep our Diamond NestEgg regulars posted with relevant updates. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's Daily Treasury Par Yield Curve Rates page, as I mentioned earlier. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, Let's move on to the next section of today's video. What's on the upcoming Treasury auction schedule? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill auctions are happening as usual. Other than that, it's pretty quiet on the auction front this week. There are no T-note, T-bond, TIPS, or FRN auctions scheduled for this coming week. For those of you who may be interested in other types of bonds and CDs, the highest yielding new issue agency bond on Fidelity's platform at the time of this taping is from Federal Home Loan Banks, with a coupon of 5.935%, a maturity date in May 2045, and a first call date in November 2025. The CUSIP is 3130B64Y9 for this bond. This last video here on the highest yielding new issue agency and corporate bonds on Fidelity's platform, linked below in the first pinned comment for your convenience, goes through more details on some of the other agency bonds on this list, as well as more details on these corporate bonds here, including this one from Jefferies Financial Group with a coupon of 7%, one of the first 7% coupons we've seen in a while. We also speak about some bonds from Morgan Stanley that are not callable at all. And corporate bonds that can't be called are another thing we haven't seen in a while. So make sure to check out this video here for sure. For brokered CDs, the highest yielding ones are from Generations Bank and Jonesboro State Bank at 4.35%. The Generations one has a first call date in November 2025, and the Jonesboro one has a first call date in July 2025. As always, if you know of any bank CDs or checking and savings accounts with particularly attractive rates at the moment, then please do drop them below and let me and the community know. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to build other sources of stable, predictable income in retirement during these unpredictable times, then check out this video here on our bond courses. And for those of you who subscribe to Your Financial Journey, be sure to check out Ava's and Caitlin's video here on President Trump's Man of the Hour on tariffs and the economy, Treasury Secretary Scott Bessent. There's more than meets the eye to Scott Bessent. In the past 2 weeks, he's basically almost single-handedly stabilized the markets and prevented a complete breakdown in our tariff talks with China. I've linked all the details on this video, our bond courses, and our YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.